Right, the three biggest justifications for failing as an investor, and specifically an investor in the stock market. Just to set the scene, we're all investors. In Australia, we are investors through superannuation, where we have compulsory saving. And in the United States, it's not compulsory, but a huge chunk of the population save through 401ks and IRAs. You can manage your own money there as well, very much the same way as we do here in Australia. And we have the opportunity to, the option to, through self-managed superannuation, and even through some of the industry super funds where you can do it yourself. So here they are, justification number one. So I'm going to go through them very quickly, and then I'm going to get into how we overcome these three justifications. Justification number one, I found, having been in this business for 25, maybe 26 years next month, and an investor for longer than that, is that short-term negative returns are the biggest excuse for taking us off our long-term path and getting us to fall short of what we're trying to achieve in the market. Volatility is another word that everybody throws about with volatility, is that volatility causes widely gyrating up and down markets, generally going sideways, but also down for potentially up to 2.5, even 3 years. And what that does is it results in drawdown in our equity curves. It results in us losing. It results in us getting feedback from the environment in which we're operating that is negative. And it could be, if you take 2000 to 2002, a very long time of just getting beaten up. And these are periods of adversity. Now, how we handle that adversity really determines how successful we're going to be. But we even now have just had a short-term period of about 3 or 4 months of sideways moving equity curves, and people experience pain, or the market just seems to go nowhere. And I'll go through some of the comments and feedback that I've seen with my very own eyes, quote unquote, in a moment, and what to do about those. But the resulting in drawdown causes emotional pain, and it causes fear, uncertainty, and confusion. And human beings hate being in that state of any of those and all the other negative feelings that go along with it. And what this period of adversity does is it causes pressure, it puts pressure on us, because there's no pressure on us when the markets are going up and our equity curves are rising and we see lots of green and we see 3, 4, 5, 6%, daily moves of some of our stocks. That doesn't cause any pressure. The other side of it, if it keeps going too long, it can cause euphoria and get us and cause us to make mistakes. But the far bigger cause of mistakes is the pressure that comes from adverse market environments, and it causes us to break ranks, to start doubting ourselves and losing trust and confidence in our edge and our process and what we do. We are getting tested in these environments, and we need to get tested because we don't grow unless we are being tested. And times of adversity are the best way to get tested and to be able to grow, to come out the other side and be a better investor as a result. We question knowledge and we go looking for new knowledge. We question our skills, our own personal skills, and being able to execute in the environment of the stock market. And it's good to question, and it's good to review and reflect. There's no doubt about that. But what we don't want to do is for this environment to make us inconsistent and subjective, and to take us off our long-term path. So the first one is short-term negative adversity, negative returns, volatility. That's the first justification. The second justification is, quote unquote, the market is too whatever, and we'll do this, and therefore I'm going to do that. So-and-so said the market is going to, so I will do this. Some classic examples, which I've spoken about in the last month or two, are some high-profile people. And shortly after COVID, when we had the bounce up from 23rd of March 2020, the bottom of the COVID crash, markets had fallen over between 30 and 38% around the world, and we had the bounce, the quick bounce. And we had people high profile going on record in newspapers and on TV saying, this is a dead cat bounce. I'm at 100% in cash. I'm going to wait until the end of the year to see what happens. So what were they doing? They were predicting the future. They were chopping and changing. They did not continue to execute their edge, their process. They broke ranks from that because of what was happening in the market and because of what they perceived was going to happen in the future. They became inconsistent and subjective, and they did not stick to their process, their consistent objective process. And what they were doing was predicting the future market direction, and they were even putting a time frame on it. So I know what is going to happen. And these are all opinions, and you've heard me talk about this plenty, subjective noise. I'm not going to go into it in any detail here today, but the point I want to make here that I've made in the past is that opinions and subjective noise have unknown edges, and yet people, they still respond to it, and they make big decisions based on trying to predict the future. So what does predicting do? When you predict or you read other people's predictions because so-and-so said whatever, what that does is it creates expectations. And what is an expectation? And expectations are a mental representation of how some future moment in the environment is going to look, sound, feel, smell, or taste. Depending on how much energy is behind the expectation, which we create, it's a perception, right? It's a mental representation. It's not something that's happening. It's predicting a picture of how it's going to look in the future. It can hurt a lot when it isn't fulfilled. And that's a quote unquote, from Mark Douglas's book, Trading in the Zone, on page 39. I'm going to give you some more quotes to urge you to go and read other parts of Mark's book on this subject and others. But it can hurt a lot when it isn't fulfilled. It doesn't necessarily mean that we stayed invested in the market, went down, we had an expectation it was going to go up and it went down. But it also means the flip side is that we have an expectation that it's going to go down and we go 100% into cash based on a whimsical, on the spur of the moment decision, takes us out of our process, and what happens, the market goes up. And those can hurt sometimes a lot more than us remaining invested according to a process and feeling a little bit of emotional pain. So that justification number 2, to break ranks, to break process, to chop and change, to become inconsistent and subjective, is predicting, us predicting or listening to somebody else's predictions. Basically saying that we know what is going to happen, therefore I'm going to take this firm action. Right, justification number 3, I don't have enough time. Now, I don't know a single person in my group of circle of friends and family that isn't busy. Everybody is busy. It just depends what we choose to be busy at. What do you choose to be busy at? That's worthy of our time. Is it the right thing to do? So are the things that are taking up our time, are they the right thing to do? Are they worthy of our time? Are they helping us grow and make progress in whatever area of our life that we want to? Are the things that we're spending our time on important? Are they urgent? Do they give us joy? Do we feel joy from the time that we're spending on these? But really, when you get a combination on spending time on things that are important and you get joy from it, that's probably the best time that you can spend doing it. What is written on our list of priorities? Because at the end of the day, we can only focus on one thing at once. Sure, we can outsource and get other people to do things, but we have to work out a list of priorities. We have to work out, and really it's the one priority, the one task, the different areas of our life are all relative. It's relative, and we need to go through which ones are relatively more important, more urgent, more joyous, more right, more worthy of our time than others. And I think we have to be a little bit ruthless about this from time to time. We need to stop and reflect and see how much time we are wasting, that we are spending rather than investing. Just rather invest time than spend time. Sure, we're all busy, but what do you want to spend your time on? What should you spend your time on, even if it doesn't initially give you joy? What do you choose not to invest your time in? Typically, if you feel fear or you're not getting joy from it, or you have low or no knowledge, or you find it hard to do, these are areas that we take path of least resistance because there's some hurdles to overcome. So we choose not to invest our time in it. Is that the correct decision? Are there things that we fear or don't give us joy in the short term, but we need to do in the long term, that we need to overcome? We need to get through, we have to break through some barriers, we need to overcome hurdles, jump hurdles to be able to get there, because we know it should be worthy of our time, because it is the right thing to do, because it is important, urgent, and that if we do persevere, we will feel joy. If that's the case, then we should be putting those onto our list of priorities, onto our to-do list, to grow in that particular area, so that they become less difficult to do because we get more joy from doing it. Now, I'm going to leave that up to you. I'm not going to suggest that you have to or don't have to do something, but obviously what I'm talking about here with respect to investing is that you're not having enough time really is a poor excuse for anything in our lives that is important in the long run and that we should be spending time on. So, summary of the justifications. Short-term negative returns and portfolio drawdown is a justification to chop and change and to become inconsistent. Market volatility generally causes negative returns. Market volatility is synonymous mostly with the market going down, but the market can also rise when we have short-term volatility, although very, very rare. But second justification is predicting. I know what is going to happen in the future, therefore I'm going to do this now. Takes you out of the opportunity flow, takes you out of the process. And the third justification is not enough time.